Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully all of you had a very good day and a very beautiful weekend as well. And in today's markets, guys, well, the declines pretty much continue across the board. What started off Friday as a big gap down session where all major sectors ended up pretty much in the red, continued into today's trading as well. Another big gap down open day. And at one point today, the SPY was down almost 1.5% and the QQQs were down almost 2%. So what exactly happened, guys? Well, we did not have any major news catalysts, no economic news, no political news, no war news headlines whatsoever, and definitely no earnings as well. Today could pretty much be summed up to a last day of profit taking for some institutions because the markets are decently up across the board for the year, and maybe even some tax loss harvesting in some of the sectors that have not performed too well at all. All in all, guys, end of year volatility in a nutshell, pure price action, no major news catalyst to speak of. But I'm pretty sure you guys can sense that the market is a little bit tense right now, and that has been the case since the Jerome Powell candle just a few short weeks ago. After the election, it was known as the pretty much everything up rally. Everything was skyrocketing, all major sectors were participating, and since Jerome Powell, I'm pretty sure you've noticed, there's been a change in sentiment in the market. A lot more uncertainty has been put into the market, and a lot more volatility has come into the market as a byproduct of that uncertainty. And as I was saying, after the Jerome Powell candle, guys, I've maintained the same approach since then. We can possibly see this volatility until maybe the end of January. Why? Well, because we have a lot of uncertainty catalysts on the horizon. Number one is going to be the inauguration day with Trump on January the 20th, where we finally get the former president's new policies that he's going to try and implement over the next 4 years. The last week of January as well, not only do we start our big tech earnings, but we also have a possible pause from the Federal Reserve and new guidance in terms of the interest rates for the remainder of the year potentially, and what exactly they feel about the level of inflation right now. We have a CPI report as well coming out in just about 2 short weeks worth of time, and if that report comes in a little bit higher, it will go to reiterate some of the concerns that the Federal Reserve has had when they released the SEP just 2 short weeks ago, whereby they raised the average interest rate forecast or projection for next year, and they also raised the target inflation projections, revised up since the month of September. So the Federal Reserve inserted a lot of uncertainty in the markets, and now you can feel an atmosphere that is quite tense, a lot more tense than it was definitely a month ago. And this volatility can simply continue through the month of January, guys. My guidance has largely remained the same since that day. You can go back on that day and check my video, and I said I would not be surprised if the market remains volatile and remains uncertain as to direction until maybe the end of January. So in today's video, guys, a lot of things to cover. Number one, we're going to be going over a lot of technical analysis in terms of our major market sectors. See how we stand after these 2 big days worth of sell-off. Thereafter, take a look at our big tech names, see how they stand as well after these 2 last days, because no real aspect of the market has been participating to the upside in the last 2 days of trading. It has been a broad market sell-off without any news catalysts whatsoever. And lastly, we'll take a look into my portfolio for a few of the trades made today and how I remain positioned. You will see it is quite cautious leading into the month of January. So a lot to cover in today's video, guys. Let's jump right into the action, shall we? So the SPY down about 1.14%, the QQQs down 1.33, but look at the list right here. Everything was down, and today, as opposed to many other days that we've had in the last 2 weeks, it was definitely not the fault of yields. Even yields were to the downside. This is supposed to help equities. This is supposed to help bonds as well. Well, the bonds responded well, but equities did not respond either. So the correlation today was definitely a little bit broken. That being said, take a look at the heat map, guys. It was not good. Pretty much all of your major sectors, except for a few names in energy, were red on the day. Definitely not a good day. It mimics exactly what happened last Friday as well. If you put this on the 1 week relative, you'll see on the 1 week relative, it doesn't look too bad. Still, some names were green, some names were red, but look at the last 1 month. And this is what I mean, guys, since the Jerome Powell candle, arguably since the early portion of December on the SPY. Take a look right here, right? Here is the early portion of the month of December. Right about here, we have not done anything. Barely pushed new all-time highs on the SPY, and then ever since, it's been just very volatile with very large moves in either direction. On the 1 month relative, everything is red except for your big tech names. Why? Well, because there's been somewhat of a somewhat silent rotation to safety, whereby traders and institutions are rotating out of some of the value names, out of some of the ones that may be affected by inflation and interest rates being higher for longer, and pivoting back to the good old trade that made everybody a lot of money in 2023 and early 2024, which was big tech. This was the most popular trade during early 2023 through 2023 and 2024, when there was concerns about rates being higher for longer and the possible resurgence of a second wave of inflation. Why? Because big tech has the most pricing power in the entire game right now, and they're sitting on the most amounts of cash. So they are not really affected by the direction of interest rates, and they're also not affected by inflation that much because they have almost limitless pricing power. They can price pretty much all of the competition out of the game right now, which is why big tech has been holding up better than most, which is also why over the course of the month of December, I was saying that this probably was going to be the easiest trade of them all, and it did play out that exact same way. And I do think that this could also be the case leading into the month of early January and maybe even a little bit of the early month of February. Now, we won't have the monthly candle closes for a few short days to come, but we'll cover those monthly closes probably tomorrow in after the hours when we do our daily market recap. On the one-day relative, guys, you can see, right? Destructive day, just like Friday. Everything to the downside except for energy, led by consumer cyclical, healthcare remaining weak as well. 1 week relative, well, we did have some outperformance in energy, but the rest of everything, I mean, financials up slightly, but everything else to the downside. And here's the kicker, guys. 1 month relative, you can see, not looking very good for the broad-based performance of the market. Only communication services, which is largely just Google and Meta, right? Communication services, technology, and some consumer cyclical names putting out some gains, but the rest of the market kind of having the silent sell-off, which we had been noticing when we were measuring not only the Dow Jones, but some of the value ETFs as well, right? Look at the IVE. This is the value index ETF, down back to the lows that we were at just after that Jerome Powell session. And the same thing for the Dow Jones, and the same thing for some of the dividend ETFs, such as SCHD, revisiting the lows really quick after a very, very, very muted bounce as a whole. So the markets do remain in an atmosphere of somewhat uncertainty. And as I said, guys, we probably will not get any confirmed resolution to this uncertainty much before the end of the month of January. So what I'm saying essentially, guys, is it could be a very big bumpy session in the markets, at least over the next 30 to 45 days worth of trading. I would not be surprised if we continue seeing a lot of these whipsaw moves, a lot of these big volatile moves, big upswings, but also very big downswings, traps all over the place, right? Bear traps, bull traps everywhere, and not few and far between, but more likely than not at this current time. Let's take a look at what Wall Street was saying today, or rather what the media was saying, trying to justify today's declines, right? So the Dow drops 400 points as Wall Street limps into the year end. There was no apparent news catalyst for Monday's decline, exactly what I was saying. And trading was expected to be light given the shortened week. And this is true, but you can see on the SPY, the last 2 days of trading, we've got more volume in these last 2 days as we had the entire every single almost daily candle in the early portion of the month of December, when the markets were just kind of drifting higher mode and there was no concerns whatsoever. Now we can see very heavy volume since Jerome Powell, which can lead us to believe that there's some heavy repositioning underway right now in the markets. Moving on to the article. Now, the major averages are heading into the year end shy of record levels, with the S&P and Dow up 24 and 13% respectively, decent years for them, and on track for the best year since 2021. The Nasdaq has gained almost 30% in 2024 and is also on pace for the longest quarterly winning streak since 2021 as well. However, some worries have mounted that the market may be losing momentum, with what appears to be year-end profit taking after the major averages notched losing sessions Friday and today as well. Now, here's what Jeremy Siegel, right, senior economist at Wisdom Tree and professor of finance at the Wharton School of Business, very, very, very smart individual, Jeremy. I really think we're going to take a pause this next year. I think the probability of a correction next year, which is defined as a 10% drop in the S&P, is getting higher. Well, take a look, guys. We're already down from the highs. I mean, if you go back to the, after Jerome Powell flush, that will be 4%. And we've had a few 10% corrections on the SPY over the course of the current year so far, right? In the last year of hindsight, we had one coming down pretty much. Well, it wasn't quite 10%, but almost, right? In that August sell-off, when it culminated in the Japanese carry trade unwinding, we've had a few, spurts of downside. The S&P coming down 6% in the month of April. But to get a true 10% top to bottom correction, you would have to revisit the lows of the fall 2023 drops. And the QQQs have been all that volatile as well. April, we had a 7.5% drop. In the month of August, top to bottom, we had a 16% correction. But there's been a lot of volatility this year, to say the least, right? So moving on in, now we also have an opposing view. So that's Jeremy Siegel's view. We also have an opposing view, which I'll present to you right now. The S&P 500 has now fallen more than 1% in each of the past 2 trading sessions. This is the first time that has happened twice in the last 5 business days of the year since at least 1952. This is the arguably worst Santa Claus rally, guys, in the last 60, 70 years. And you can thank one person for it, in my humble opinion. You can thank Jerome Powell for inserting a lot of uncertainty and a lot of doubt into the markets moving forward. Now, here's what somebody else had to say about the direction of the markets. Investors shouldn't worry too much about late year weakness, said the perma-bull Tom Lee. He said it is not a liquid environment because we're in the final 2 days of the year. This is true. A lot of institutions are on holiday and you don't see the same price support when stocks start really coming down hard. Strangely, if the last week of December is weak, I actually think it bodes well for a rebound in the first week of January. So obviously this is all speculation, both from Jeremy Siegel and also from Tom Lee. Nobody truly knows, guys, but one thing we can understand from today's price action and Friday's price action is that the volatility is probably here to stay, at least for the next 3-4 weeks. As I always say, what does the market not like at all, guys? It does not like uncertainty. Prior to the Jerome Powell speech, there was not very much uncertainty in the markets at all. The direction of inflation was fairly clear. The direction of the pace of interest rate declines over the course of this year was fairly clear. They were supposed to be 4. But now what the Fed did, guys, they increased the odds of inflation throughout this next year. So once again, they sowed the seeds of uncertainty and doubt in terms of inflation. They also sowed the seeds of uncertainty in terms of the direction of interest rates, cutting the interest rate projection declines from 4 cuts all the way down to 2 cuts as a whole. So they threw in a whole bunch of uncertainty. And not only that, they also commented, which they're not supposed to do. They did comment that a few Fed members were getting a little bit nervous about the Trump tariff policies coming into office soon, and that could potentially be an inflation catalyst, and so they projected accordingly. The Federal Reserve is not supposed to take political stances like that, right? It's a very gray zone, but they're not supposed to do it. It's not their mandate. So essentially what they did is they put too much uncertainty in the market, guys, and what did they do as a whole? Well, they inserted a few of the catalysts for the bear market thesis, the crash, the recession, the bear market thesis. They inserted doubts that previously the market did not have, or the market was getting over a lot of these concerns. And now Jerome Powell, with the way that he addressed reporters' questions on that day, they inserted too much uncertainty. Unemployment will skyrocket. What did Jerome Powell say? He said many factors now are slowing down the labor market. Before, he was very confident in the direction of the labor market, saying the labor market remained tight and resilient. Now he said there are many factors currently afflicting the labor market. Not good for the labor market thesis, is it? The Fed is too late, damage is done. That is still somewhat open to interpretation, but when we saw them pivot from 4 cuts down to 2, it lets us know that maybe the pacing was wrong. So they inserted uncertainty there as well. The data is fake. CPI, jobs, and economic output. Well, now that the Fed has been revising their projections for interest rates, and inflation, and inserting uncertainty in terms of jobs, it begs the question, was the data fake or not? Is the Fed not telling us something? They did not help that. Trump, tariffs and economic mismanagement, inflation will come back. Well, the Federal Reserve literally hinted that that could be a possible outcome. So they did not help this as well. Market is overvalued. This has always been the case, but now with the uncertainty inserted by the Fed, this becomes front and center. Buffett is in cash, other notable CEOs selling. That's always been the case. US debt ceiling crisis, that has been front and center on people's mind. Jerome Powell, 2 Wednesdays ago, said it was unsustainable, right? So that as well, more uncertainty there. Consumers over-leveraged on credit. We saw the banks, we saw the credit cards. This largely was not the case, but remains to be seen. Commercial real estate crisis. People have been waiting for this for 2-3 years. We'll see if it actually happens. Rest of the world in recession. This is true, but a lot of money has been flocking to the US markets. The AI and tech bubble. Well, of course, when Jerome Powell pops the bubble of everybody's euphoria and bullishness leading into Christmas, well, what do you think happens? People immediately start thinking of all of these things, but this as well. Are we truly in an AI and tech bubble? And people take their foot off the gas, take their foot off the trigger, and stop bidding up a lot of these AI companies that have ran a lot. The yield curve uninverting triggers a recession every time. We'll see if it actually does. The SOM rule, 0.5% increase in unemployment in 3 months from the lows. We will see that again if that triggers a recession this time around too. These two things would only probably take effect late 2025, so we'll see that. Manufacturing output is weak. That is definitely true. And, these last two ones, the anecdotal experience by friends or broke, that's up to you, obviously, depending on your friend circle, depending on which, status of the economy you're in, whether you're low income, middle income, high income, this could obviously be different, which is why I say it's anecdotal experience. It's true to you, not necessarily somebody else. And indicators, smart money versus dumb money. Well, we saw what the smart money versus dumb money was doing. They were buying the dip last week aggressively, but remains to be seen. I'll try to get a chart from this week. The institutions were stepping in to buy the dip over the course of last week as a whole. However, we will see if that's still the case, right? They were coming in here for the dip buy. Retail was flushing and the institutions were buying the dip. This is after the correction that we had last week, right? That's what led to a lot of the big bounce that we had in the S&P over the course of these couple days of trading leading into the Christmas holiday. That being said, smart money versus dumb money. Well, we'll take a revisit this week. Percentage of stocks that are above their 50 or 200-day moving average. You can see, guys, as we noted, it was weak. It was very weak, right? Take a look right down here. You will see that only 32% of stocks are above their 50-day moving average. This is some of the weakest reads that we've had all year. Could be a buying opportunity, but it can also go a lot lower. As we can see, last fall when the markets really had the actual correction, it went down to 20. So we do not have the broad market recovery that we were looking for. It is still a top-heavy market. Even though big tech was down today, you can remind yourself, right? Big tech has largely been the only winners over the past month of trading, which leads to all of this weakness across the broad market. And percentage of stocks above the 200-day moving average stays poised at about 51%. Arguably some of the lowest reads that we've also had last year, but it can always go lower, as we can see back in the periods of 2023. It can always go lower, guys. So that was not good at all. Put to call ratio, a lot of people were only in calls, no puts, which is why the put to call ratio was low. Now a lot more people are buying insurance, buying protection leading into the end of the year and January. And the VIX has spiked up pretty much over to 25, 28 last week. And you can see the remainder of the VIX, although we did have a big spike today, it remains slightly elevated. And this can continue to stay elevated between 15 and 22 over maybe the course of the next month as we continue moving forward with this uncertainty. So as a whole, as you can see in this big market introduction, guys, a lot of uncertainty has been put back into the market. So even though we did not have any major news catalysts warranting these drops, you can obviously tell that the reason behind these is all the uncertainty that was brought into the markets just 2 short weeks ago. So hopefully that helps in terms of an introduction, guys. Moving forward, we'll only cover the price action, but I figured I should talk about this as we kind of wrap up the last month of the year, the last few trading days of the year, and embark on the process to January. So I will leave this, and if tomorrow I want to reference this section, I will reference it to this video, but this is the last time I'll be bringing up this over the course of this entire week. So hopefully you guys appreciated that. Now let's move directly into our technical analysis, shall we? So moving into the technical analysis, right? SPY not looking too good, guys. Daily downtrend was clear as day. We got the very nice almost engulfing bounce on the SPY, right? This was a 78% bounce, and even that did not matter. Now, the bulls have not given back the lows just yet, but when you give back so much of a move, guys, the best case scenario oftentimes is just a tightening range, right? Trapped between two levels, overhead resistance and current support. The worst case scenario, of course, is just the pure rollover and daily downtrend continuation. That was always the expectation, was for a lower high, and then it's up to the bulls to prove to us that they want to reclaim the daily uptrends. So far, they have not reclaimed the daily uptrends. They still have one final chance to try and get it together, either in a V-shaped recovery process for the daily uptrend or the two-step recovery process, tighten up a little bit more and then go for it. However, if we flush these lows, daily downtrend continues, we'll be moving further and further down into our support range, 585 down to about 575. And keep in mind, guys, as we move lower and lower, if we do breach these lows, the gap fill down here to the 5th of November candle, the election candle, right? The gap down fill to 574 becomes more and more likely. Thereafter, the next support range would be 568 down to 559. And if we go all the way there throughout the January volatility, that will be your S&P 500 correction as a whole. That would also be a weekly large period of consolidation, the same as which we saw here and here in the markets. It would not be surprising in the least. You've seen them do it before in periods of high uncertainty. April and August. I'll remind you, what were the catalysts? The catalysts were the same. They were inflation, second wave of inflation concerns, and number two, interest rates higher for longer. This is the same thing that's been afflicting the markets as of right now. So I would not be surprised, guys, especially look at these monthly candles. SPY closing red on the month pretty much. We would not be surprised if the bulls take this chance to set up for a monthly higher low through the month of January before possibly resuming when there's more clarity in the markets. This chart would not look surprising, right? They do it all the time. You do have to eventually set the monthly higher lows if you want to continue this nice uptrend. So keep that in mind. The QQQs, largely the same analysis, right? We had a very nice daily uptrend, gave it back after Powell, tremendous bounce by the bulls, but now look, we've given it all back. Almost 75, 78% bounce there as well. It gave the bulls a very good chance of recapturing the daily uptrends, but they could not get it done. No follow through to be had. And now we find ourselves right back towards the lows, right back at support 515 down to 510. Now the bulls, it's not lost all of as of just yet, right? We have two scenarios for upside. Either they try and set the higher lows now and go for the full V shape into new daily uptrend, and all of this gets put behind us, right? However, the more likely scenario is the tightening up of the range if they want to hold support. But if the bears get a little bit more follow through, guys, right? It would look very logical. Lower high, lower low, daily downtrend continuation, and that would send us into more weekly consolidation. Good thing for them. The bulls have still a decent amount of space. Anything above 495, looking for a weekly higher low for possible further trend continuation. The bulls have lost the 12 EMA a few times this year. Once here, twice there, 3 times there. So can we possibly consolidate a little bit lower and lose even more ground on the Qs? Absolutely, guys. And take a look at this monthly candle, monthly doji, a big wick on top. Usually when you have a big wick like this, it's not surprising if the markets can go for their period of monthly consolidation, which we can be expecting after 3-4 months worth of rally. Can January be red as we move through uncertainty? Well, we definitely have all the catalysts for it, guys. So if they're going to do it, you know, they have all the excuses to possibly do it in the month of January. So do not be surprised. That is actually my expectation. I am cautiously optimistic in the markets, but we have to be realistic as well. Nobody would blink an eye if in 4 months, 4 or 5 months, when we look back at this, if there's a higher low and trend continuation, would this move look so awkward? No, right? It would just look like a normal monthly higher low in the context of an overall uptrend. So you have to keep that in mind. They have all the catalysts in the world, all the excuses in the world, and all the earnings in the world to drop these markets through the early month of January and also the early portion of the month of February. So we have to give that as our baseline. That now becomes my baseline scenario. As we saw, these bounces were so easily given back when there was no news whatsoever. It goes to show you guys, the market's going to look for any and each excuse to possibly give us further downside, shake some people out, and just insert a lot of uncertainty in the bull market thesis before possibly trapping the bears and moving on a little bit higher, because the economic outlook and the earnings growth for the market in 2025 still remains quite strong. Nothing has changed in terms of fundamentals of any of these companies in the last 2 weeks. What has changed is traders' sentiments in the market, and we know that these sentiments can be very short-lived. So we will see what happens, guys, but I'll be quite honest with you, it is not looking the best for the month of January. As I said, they have all the excuses in the world to possibly drop these markets. So now is the time covered calls, raising some cash, build a watch list if you're sitting on any major gains and you want to possibly sit out the volatility that could potentially be here in the month of January and early February. Now is possibly the time to take that into consideration, right? Especially when you have the QQQs, monthly overbought conditions, the SPY as well, monthly overbought conditions. It is a perfect recipe for some further selling off in the early stages of the month of January, and maybe even leading into end of January at the earnings with Trump, with Powell coming in speaking the 29th of January, and then early February as well as we wrap up the earnings season. So that is the case. Now let's fly through a little bit more of these very quickly. So the XLF still in a daily downtrend, perpetually in a daily downtrend. Lower high is set and now possibly even looking for the lower low. We know that the bounce size was very healthy. As we can see, it was a almost 75% bounce. But as with the rest of the markets, nothing is guaranteed. The bulls need to play defense and get the trend conversion. Other than that, you're always just looking for a lower high and lower low. It's up to the bulls to convert this. If they can't get it done, we are retesting these lows, 47.38, support 47.71 down to 47.18. And if you flush this, guys, well, we are just going to continue in further and further and further weekly consolidation for pretty much arguably the last 5 weeks in a row. Weekly higher lows are here, 45.87. We have not lost them just yet, but the more and more the bulls give back of this move, guys, the more likely the scenario becomes either lower high into lower low into possible monthly consolidation for the XLF as well. They've ran a lot. They're well extended from the 12 EMA, and sometimes you can have a bit more snapback before continuation of the rally. So keep that in mind, guys. Or the other case scenario is just a sheer large tightening range, because when you take back too much of a move, the V shape becomes very, very difficult. Moving into the XLV. So I'm being very patient on financials as well. The banks have run a lot. The credit cards have run a lot. I see no deals in that sector as a whole, so I will be very patient. Moving into XLV, same concept, right? Daily downtrend was clear as day, and the bounce size out of all sectors was arguably the weakest across the bunch. Look at the bounce size. 38% bounce size only. So if we get one big day of downside like this, what are the odds, guys? The odds are very likely that the bulls just continue losing ground, revisit the lows, or flush the lows. The bulls still have a chance at resetting the daily uptrend, but they do not have a very high chance. So we'll see what happens. But if they just maintain this weekly downtrend and daily downtrend, we are going a little bit lower on the healthcare sector. And I would not be surprised, guys. A lot of uncertainty in the healthcare sector. What is Trump going to do with the healthcare companies? How is he going to potentially reform Medicare and Medicaid? Or is he going to touch it at all? And what is RFK Jr. going to do in terms of pharmaceutical companies? That as well, two major uncertainty catalysts for the healthcare sector, which is why it's been so out of favor. All that being said, on the monthly, look at this monthly candle close, guys. Gives us impression that we can drop a little bit lower, go further and further into this prior area of resistance, which will now be support. I know I put the area up here, but it's also this whole range, right? You can really widen this out a lot. It's this whole range that we're kind of coming back into the prior range of 2022 and 2023. That is the big support zone. So if you lose this, you'll lose the monthly uptrends. We're on the verge of doing it now. Loss of the monthly uptrend. It may take a while to get this one back. So I would exert some caution when trading this sector as a whole. Moving into semiconductors now. Semiconductors still directionless, right? A lot of volatility, but no clear moves up or down. So we stay range bound right now. We stay trapped between two levels, 260 down to 250, and to the downside, this overhead resistance, of course, and to the downside, 232 down about 220. As a whole, no clear direction, just very muted sideways action across the whole sector as a whole. So that being said, guys, a few key players have performed nicely over the past few weeks. AVGO, NVIDIA, TSM to say the least, but we have not had any broad market performance from semiconductors in a very long time. It is few companies here and there, but we cannot say we have a broad market rally. One of two things is going to happen, guys. If the markets are very weak in January, we will be revisiting these lows, 232 down to 220. It will be a perfect opportunity, in my opinion, if we do come down here, to be riding short puts under the market on your favorite semiconductor companies. And in the event we crack above higher, well, then you have your answer, guys. If you close a weekly candle above 260, close a hard weekly candle above 260, the likelihood of follow through, getting the breakout, retest, and run becomes very, very likely. And that is when you might get your monthly trend expansion, because as of now, it's been doing a whole lot of nothing for the last 6-7 months, just tightening up of a beautiful range. Where is it tightening up though? The higher end of the move. This does look like a giant bull flag getting ready to pop sometime in 2025. Now let's move into the Russell. So the Russell continues being weak. Look at this monthly candle on the Russell, guys. If it closes like this, massive supply zone, and it makes perfect sense, right? Inflation concerns, A lot of these small cap companies, what do they not have? They don't have pricing power, that's for sure. A lot of them are not profitable, and they also do not have something else. They do not have the benefit of waiting for interest rates to come down. If they have to refinance debt, they'll have to refinance debt at the current 10 and 20-year yields, which are very, very high. So the Russell is just being plagued by everywhere right now. And as you can see, continuation of the daily downtrend is in motion right now. They flushed the lows, did not close below it, but we can argue if the markets remain weak, guys, this is a new leg for the daily downtrend. Support below becomes 216 down to 207. Not looking the best, even on the weekly time frame, guys. Complete flip of the weekly, right? We had a very nice weekly uptrend, loss of the weekly uptrend, and now just might be looking for further and further and further weekly consolidation. Any bounce will be met by resistance up here, 225 to 231, resistance, and then you may get the second leg of weekly consolidation down. I think the true bottoming out area for the Russell has to be down here, 216 down to about 205. It would not be surprising. That's the area that we found a lot of support back in the past and has been an area of congestion for the markets of many few times over the course of this year. So that is the area that we might be targeting for some potential further positioning. But right now, in between two levels, kind of equidistant between the support and the resistance, I'm not playing the Russell right now. Too many uncertainty catalysts on the near-term horizon. And now lastly, the Dow Jones. So the Dow Jones, we know that value has been relatively weak. The entire market has been relatively weak. Only big tech has been the biggest outperformers over the course of the last 1 month. That is definitely not good for the Dow Jones, of course. So the Dow Jones daily downtrend is highly likely. Why? Well, take a look at the size of the bounce. The bounce size was only 38.2%. So when you get such a shallow bounce and roll it over, well, the likelihood of retesting the lows or moving lower is very high. So that is exactly what's happening right now. If we flush these lows down here, guys, 42,200, and we continue closing lower, daily downtrend simply continues at that point, and we are heading even lower into the next big area of support, which is down here about 41,800, decent level as well, but an arguably bigger one comes down here about 41,200, and that would be a correction for the Dow Jones. That would be a sell-off of 8 all the way down to almost 10% if we were to embark on that journey. Another thing we've lost on the Dow Jones is the weekly uptrend. We had the weekly uptrend, loss of the weekly uptrend, and just no bounce in sight, right? This is one big weekly move to the downside. So what the bulls need to do, guys, they need to get their butts in gear and get this daily uptrend going right away, because if we flush, they're going to have to start everything from scratch, the daily uptrend process. You know, we're going to have to get a bounce, measure the size of the bounce, and then we're going to have to get the absolute follow through eventually. But as of right now, not looking too good for the Dow Jones. They're playing a little bit of defense here at the 26 EMA. The only time we've lost the 26 was on the Black Monday sell-off after the Japanese carry trade unwound. We have not lost the 26 ever, unless from this one, have not lost it in 2 years, guys. So if we lose it into January, it definitely shows you that something is going on under the hood in the markets and that more volatility can possibly be on the horizon. Is this move overdone? Yes. But does it mean it has to stop right now before shaking a lot more people out? No, it can go on further. We can even come down and touch the 200 EMA, which we have not done in a very long time. So keep all of these factors in mind, guys. January could be a lot more volatile than some people are expecting. Now, that's pretty much it for our major sectors as a whole. Let's move into some crypto, and crypto has been doing a whole lot of nothing, so I'll only cover Bitcoin because we did a very big analysis on the Friday session. Daily downtrend simply continues. Lower lows on the Bitcoin right now. So moving in, guys, last support area, 91.7 down to about 87 is the last support range. And we're doing a few key things. The moving averages have now crossed over, leading into bearish sentiment and bearish momentum. We are now below the 50 EMA. We have not closed below the 50 EMA on Bitcoin since a portion of the rally started in October when we were still in the 60K range. So Bitcoin quickly unraveling right now, which leads us to believe that we may just be on the verge of further and further weekly consolidation. We have a few key moving averages here, the 12 at 88, and then the 26 down to about 80. If you come down into the mid 80s, guys, I think that is where probably the pain is going to be stopped. I do not think, and what I think, obviously, I don't know, I can't predict the markets, right? I do not think we're going to give back the entire move. I think the maximum pain probably is somewhere here in the 80% range. If you look at the corrections for Bitcoin this year, usually they've always been about 20, 25%, no more than that, right? If you look at these, about 25% top to bottom, and every single time we get a big pullback, it's usually about 20%. At least it has been since the rally started late 2023. So that is where I think the pain might stop. But as of right now, crypto is still looking weak. being pretty much as a byproduct of the rest of the market being weak as well. And obviously, guys, if Bitcoin is weak, well, everything else in this list is going to be weak as well. Ethereum, very weak. Support below us now is about 32 down to about 3,000. 200-day moving average comes in there as well. But look, I mean, we've lost all the daily time frames. We've lost the daily uptrends as a whole, just consolidation with a weak bias to the downside. We're now below all the moving averages on Ethereum as well for the last couple of weeks. And weekly consolidation just continues after this very big move. Weekly higher lows are being sought after, but in the event we set this high and break 3,000 to the downside, that will be weekly downtrend on Ethereum, and we could be revisiting 29, 28, and that would be giving back the entire move. Is it all over for Ethereum? No, I wouldn't go so far as to say that, but it would be a very, very big pullback leading into January consolidation. I still think Bitcoin has not hit the highs of the cycle, but look at this monthly candle. It closes pretty much tomorrow, right? Would not be surprised if, similar to the SPY and the QQQ, this monthly candle is telling us something. It's not the same environment as it was prior to Jerome Powell. Too much uncertainty, right? It was the bull market, the everything rally. People were risk on, throwing call options at absolutely everything and thinking that the sky has no limit. Now you've seen a switch in positioning. You can tell probably, right? The sentiment is not the same. When you go on message boards, Reddit, or other places, the sentiment has shifted a little bit. Yes, people are still bullish, but now they know that something is going on in the markets right now, and even in crypto as well. The sentiment prior to Powell was very, very bullish. And then after Powell, it's very easy, very quick how sentiment can change. We were above 100K, people were calling for 125, 150, 200. Now that we're below 100K, people are saying everything is over, we're going back to 60. Very funny how sentiment can shift in 2 short weeks. Look at this monthly candle. Further downside consolidation can be had as we seek to establish our new monthly higher lows for possible further trend continuation. So please keep that in mind for crypto. When we move through big tech, you will see the exact same thing. So moving into big tech right now, guys, well, unfortunately, big tech also, not performing very well today at all. Apple setting the higher lows, daily uptrend, trying to set new higher lows. But the problem is, if they give back any more of this move, they'll be taking back too much. You will lose the 12 EMA, which has been your trend guide ever since the rally started in November, right? And we're possibly looking to give back too much of this move, guys, opening the door for lower highs into possible lower lows. Daily downtrend on Apple. Look at the MACD momentum on the daily, guys. Currently crossing negative. The RSI also is establishing a downtrend as a whole, which is opposite to what the market is doing. So you have a bit of bearish divergence there. I would not be surprised, as I said, if the markets continue weak, would not be surprised if Apple rolls over. What are we going for here, guys? After 5, 6, 7, 8 weeks of green on Apple, I was telling you guys, it's a dangerous prop position to be buying into these highs right here, into weekly overbought conditions, daily overbought conditions as well, and a high valuation for Apple. So in the event that Apple does roll over with the possible further continuation on the markets to the downside, we're just going to be looking for a weekly higher low. It's a very nice weekly option right now, but eventually you do have to pull back and set the higher lows, right? Very natural price action. Where can we come down into? Possibly the 240 down into the 235 range. Weekly higher lows for possible further trend continuation into 2025. So Apple right now, although no major levels have been lost, I'm setting the expectation. Look at the monthly candle, right? Monthly candle closing with a little bit of a wick on top. Would not be surprising if we can establish some monthly higher lows in the month of January, early February, and then rally thereafter. Apple does it all the time where it takes a couple months off, tries to put in a new leg, right? You can see, go back in Apple's timeframes. It does this more often than not, guys. It is not only green, very far extended from the 12 EMA on the monthly. So I would not be surprised, guys. Would not be surprised if this is the start of something larger. I am not playing Apple up here for a swing trade, nor to the long side, nor to the short side, because I am still cautiously optimistic for the markets, but playing Apple up here so close to the all-time highs on the verge of possible weekly consolidation is not my preferred trade. I would rather wait to see what happens, and if it comes down here, that is where we get the breakout, retest, and run trade opportunity, 240 down to about 230. Moving on to AMD right now. AMD, same concept as the rest of the markets, right? AMD had a very nice bounce, right? It is a context of a daily downtrend. Everything is downtrend on AMD. Monthly is a downtrend. The weekly also is a downtrend, right? So you can't be surprised that the bias is always to the downside. We have no uptrends whatsoever. So the bounce on the daily, this was looking for step one, looking for the daily uptrend recapture. As of right now, no sign that the bulls want to protect it as a whole, right? Take a look at the bounce size. You will see that the bounce size was fairly decent, a 61% bounce. It gives the bulls a very good chance of resetting into a daily uptrend, but it does not guarantee it. So can we possibly see just lower high into revisit the lows and even lower? Yes, absolutely. It's up to the bulls in the next few days to convert this into a new daily uptrend, and then we can talk about attacking the weekly highs at around 145, but it's still looking very weak. No sign that the bulls want to convert this into a daily uptrend. It's not AMD's fault though. It's very tough for them to do it when the entire market looks like this on a day like today, right? So that being said, if we revisit the lows, 117.86, we are probably going a little bit lower because we were just going to continue this series of weekly downtrends in motion. 200 weekly is down here at 115, 200 weekly moving average, and then big support comes in 115 down to 100. I think if anything, guys, this will probably be the last area of maximum pain for AMD, taking us all the way back to October of 2023 when the stock was trading roughly for the same price. That would be a maximum drawdown from the highs of roughly anywhere between, let's call it right now, 50 all the way down to 56%. I will be more of a buyer down here on AMD. I am playing the stock here, but this is where I start to play a little bit heavier and a little bit more aggressively because the thesis for the company has not changed. The valuation is still very cheap, and I think they will still have a good chance at putting out a very good year in terms of EPS growth for the data center ramp portion of their business and a very nice year of revenue growth as well. So as long as we have very nice improving fundamentals, the stock price may not be cooperating, but that is why I'm seeking to actively build some positions in AMD as we drop. The valuation is good, the growth prospects are still good, and for those reasons is why I'm buying. Moving into Amazon right now. So Amazon as well, giving a little bit back, right? So Amazon too, take a look down here, 1.09% to the downside, flushing the lows of last week. So the context was a very nice daily uptrend. Then we got Jerome Powell, lower highs were set, and although the size of the bounce was very good for the bulls, almost 75%, unless you get the actual trend conversion, then it doesn't mean anything, right? The size of the bounce was very good, gives you the best odds, but it does not guarantee that it's going to result in a daily uptrend. That is why you have to wait and see, which is why I always say, if you're looking for a trend reversal trade, because here we had the daily uptrend, then we lost it. So then we have to confirm, right? If you're looking for the trend confirmation trade, the trend continuation trade, you may as well wait for the daily uptrend confirmation, enter here, stop loss goes here, because then at least you're sure that the bulls proved it to you. If you start buying here before they confirm, well, then you run the risk of it just being a lower high into lower low. So that is always the risks, guys, which is why I always pay to wait for confirmations when I'm looking for trend reversal trades, right? That being said, what we're looking at right now is possibly the continuation of a daily downtrend. What does that mean? We're looking for weekly consolidation now the third week in a row. Good thing the bulls have a lot of space in front of them, right? Anything at this point above 196, just looking for a weekly higher low for further trend continuation. Where could we come down into? Possibly the 215 down to 210. This will be an area that if we do pull back hard into this region over the month of January, I'll be looking to sell puts under the market, probably getting some good premium down here, 205 to 200. That is the area that I will be targeting. If we pull back here, I'll be writing some puts down here and we'll be gladly taking the shares if they assign me. I think Amazon should have a very good year in the markets, all things considered. Moving on to Google. Google, same concept as the rest of the markets, right? They had the context of a very nice daily uptrend. Jerome Powell with the flush, loss of the daily uptrend because you lost the lows. Now they had a very nice bounce. Now it's up to the bulls. Can they convert into the daily uptrend? We had a very nice bounce, 61.8% bounce. It gives the bulls the best chance of being able to reset into a daily uptrend, but it does not guarantee. We never got the confirmation. So can we possibly even roll this move over on Google too? Sure, absolutely. Now we're trying to play off of one last area of defense, which is the prior all-time highs. Newfound support for the bulls right now, but it's not the strongest area, right? If we pull it up to the weekly, you'll understand what I mean. Look, kind of topping out on Google here. Would anybody be surprised? We get these pullbacks all the time, right? Would anybody be surprised if Google moves a little bit lower, sets the weekly higher lows here, and then rallies throughout the month of, maybe end of January, early February after their earnings, which their earnings should be quite good? Nobody would be surprised. The chart would still look quite healthy, right? So that being said, if we do continue losing levels, I will be playing Google more aggressively down here. The mid 180s to mid 170s is where I really want to play this one heavier, because right now it's kind of a tale of being trapped between two levels. We're kind of equally distant between the highs and the lower end of support. So I would rather wait for support, especially with all the uncertainty in the market right now. Moving on to Meta. Meta down about 1.43%. And same concept. Daily downtrend after Powell was the case. Any bounce, especially a weak bounce, just for a lower high. The bounce on Meta was weaker than a lot of other sector peers. The bounce was only 50%. So 50-50, guys. Take your pick, right? It's a coin toss whether or not the bulls have it in them to reset the higher lows and go higher, or whether or not this is just a lower high into lower low. Price action gets to tell you, which is why I always say, if you're looking for the trend reversal trade, wait for confirmation. The entry goes here, the stop goes here, and then you target the highs or higher. If you start trading these without confirmation, you are taking a gamble, right? That being said, looking to possibly roll this over, last line of defense right now, 582. Lose this and you lose the top end of the resistance range, which is now support. You lose the 50 EMA as well, and we could be heading a little bit lower on Meta. Where could we possibly be heading? Well, good question. Anything above 550, looking for a weekly higher low for further trend continuation. Keep an eye though, give back too much of this, and we may just start and go back even more, retest the prior levels. These back here, guys, this is 540 down to about 530. That is truly the area that I want to play Meta, guys. If you get a little bit of monthly pullback here, looking for monthly higher lows, this is actually where I want to play it more. 540 down to 530. You will see me play Meta. I just have not been convinced after Jerome Powell that this was the time to play Meta. So I'll be patiently waiting. If my levels open up once again, I'll be patiently waiting for Meta. Now, moving on to Microsoft. Give me a very brief moment. Moving into Microsoft, 1.32% to the downside. Right, so Microsoft also big daily downtrend. The bounce size on Microsoft was weak. The context was a beautiful daily uptrend as a whole, right? Daily uptrend, the higher lows were right there. Then we lost them. Then the context was all the time, look for the size of the bounce. Size of the bounce was weak. 38.2% bounce only where the candle closes. So not a very good bounce. When you get such a weak bounce and the overall market is weak, well, the probability of rolling over is very high. And that's exactly what happened with Microsoft. Has anything changed in the fundamental business of Microsoft since Jerome Powell? Absolutely nothing. They're still the same extremely strong company. It's just the market overall has not been too kind to anything since Jerome Powell, pretty much. We had a nice bounce, but the bounce, as we saw, was very quickly evaporated, right? So daily downtrend continues on Microsoft. Daily downtrend means we are in weekly consolidation, and we are on the verge of losing an area we just recaptured. This area, guys, 435 down to 425. Resistance, supposed to be support, but you can see they blew through it here as well when the market was unfavorable. And this is not Microsoft's fault. It's the market. I'm pretty sure if the market was fine, Microsoft would have gone on for the trend continuation. But now if they give it all back, we will get stuck in the gulag once again. We will be trapped once again between 420 and 400, which opens up the door for some juicy trades on Microsoft. If we start retesting the mid, 415 range, it'll open up some trades again in the 400, 405 range. This is my preferred range to be selling puts on Microsoft, or maybe even positioning for some call debit spreads, things like that, because I'm pretty sure Microsoft will have a very good 2025, but it moves slow. It's not Palantir, right? So when we do take some long positions on Microsoft, you have to give it a little bit more time than some of the names that have a bit more volatility. Moving on to Netflix right now. Netflix also a very weak day, 0.78%. The context was they had a very nice bounce, and even that was not enough for Netflix. Giving it up, retesting these lows. If we flush these lows, 891, watch out. Daily downtrend is set by the bears. That would be the first. This you can argue is a daily downtrend, but this would be the first loss of the 26 EMA since the rally started virtually since last earnings, right? And that is big. When they lose to 26, it means they've lost all short-term momentum plus the daily downtrend. What does that mean? Look one time frame higher. What are we doing? We're going for further and further weekly consolidation. The weekly has been overbought. I've been warning about this on Netflix. Probably not the best proposition to be super long at these levels, guys. If we get some pullback at this point, anything above 743, looking for a weekly higher low for further trend continuation. The next area of support remains the 12 EMA at 854. So everything, it's not looking the worst on Netflix, but would anybody be surprised if after 4 months of rally in a row, Netflix goes down a little bit for January and early February, sets some monthly higher lows before putting in another good year for 2025? That would not look so awkward, right? It would look perfectly natural on this chart if you were to revisit it in 5-6 months worth of time. So keep that in mind, guys. As I said, all of these charts are set up the exact same. We can give back some ground on the January session. They have all the excuses to do it, guys. And we have earnings as well. So we have all the catalysts. It's a perfect storm in the markets right now. If there is one time when we can pull back, it is going to be the month of January. They have all the excuses for it, guys. So position accordingly and be cautious accordingly as well. I'm not saying it's going to happen. I'm saying they have all the excuses in the world to make it happen if they want to, right? You guys know how the markets are. Whenever they see something and they smell blood in the water, they can run with it very, very quickly. Moving into NVIDIA right now. So NVIDIA with a great bounce off the lows. NVIDIA, as a matter of fact, was up, at a certain point today. NVIDIA was up almost, 2.5%. And they gave back a lot of that move towards the end of the day and the end of day candles, right? The last 15, 30 minutes of the session were brutal across the board. We did have a nice bounce, but NVIDIA, is kind of, trying to protect this daily uptrend formation pattern. So as of right now, it is a daily uptrend. We are looking for a daily higher low, anything above 128.41, looking for the higher low for possible further trend continuation. But my question to you is, if the market remains super weak and the SPY and QQQ keep dropping, do you guys think NVIDIA is going to be able to do it on its own? Probably not. We're probably going to revisit these lows. That being said, support is down here, 129 to 25. And in the event we roll over this entire move, it would just be looking for a weekly lower high, right? High, lower high, lower high, lower low, lower low. It has been a weekly downtrend on NVIDIA now, so no one should be surprised if we do roll this over with the rest of the market. Where are we heading, guys? We're heading for a possible weekly lower low, which could send us down into the low 120s, all the way down to about 115. That is the large line of defense as well, would line up with the 50 weekly EMA, and NVIDIA has not retested the weekly 50 EMA, guys, since the entire AI narrative started, right? So that would be a big decline for NVIDIA, but that would be a likely area where I think a lot of dip buyers will be coming in. That would be a sell-off of NVIDIA of 27% to the highs. I'm giving the expectation for the month of January, guys, because you guys know, look, would it look so awkward on the monthly? Higher lows here, monthly highs, higher lows back down here into 119, 115. Would that look so awkward? Retesting all this zone right there where the candles close, retesting like this, and then on to nice 2025, it wouldn't look so awkward, right? So keep these scenarios in mind, guys, because the last thing that I want to be able to say is I told you so, right? So keep that in mind when you're viewing your positioning, possibly erring on the side of caution for January may just be the most prudent thing to do. We may get some tremendous buying opportunities. And as I said, right, if they play out on NVIDIA, right? If these are truly going to be the monthly higher lows before a nice period of rally, these may be some of the last buying opportunities that you have at these levels before we start going onto those rallies. I would rather save all my buying power for those super juicy levels than ride the market into a decent February, March, April, May, and then probably the summer is going to be a little bit flat, right? So that is how I'm looking at the next 30 to 45 days in the market, saving the buying power. And if I see my levels, I'm going to go shopping heavy, and then we ride the market into the next leg of bull expansion. We won't get any economic unraveling, in my opinion, at least until the second half of the year. We're probably safe from any crash or recession thesis until the second half of the year. First half should be pretty good. January could be red, early February too. Then we get the last rally. Then we're going to make a ton of profits. But then midway through the year, we've got to be a little bit careful as well, guys. That's how I'm seeing it if you want to know my perspective. Tesla rather to the downside, 3.3%. Well, Tesla embarking on possibly the continuation of a now daily downtrend, flushing the lows, 417. 418 roughly, flushing the lows today. Daily downtrend on Tesla is highly likely now. Good thing for the bulls. They have a lot of support below them, right? 410 down to about 380 is going to be that last line of defense. Tesla also reporting deliveries. I believe they're coming out January the 2nd because tomorrow is going to be a holiday. Usually they do it on the 1st, but they should be out January the 2nd. We should have them by Thursday. So deliveries, big catalyst. The stock can move 5% up or down after deliveries. I would not be surprised if, any excuse is used to bring the stock down a little bit more. Why? Because they already have the daily downtrend. We're losing momentum right now quickly as a whole, and big support down here. And the weekly, look at this weekly chart, right? Loss of momentum. Now it is still a nice weekly uptrend. Higher lows are set here, 330 pretty much. Anything above that, looking for a weekly higher low, this would be a perfect catalyst to drop Tesla into this zone, try to establish a higher low on the weekly, and then we can see, can the bulls have it in them with earnings to possibly push a little bit higher? Weekly timeframes are overbought. We are just cooling down all of the higher timeframes, which is why I've been so patient with Tesla, not chasing the market up here. exerting caution a little bit. If we do come down deep into this zone, it will free up some short put opportunities down here, 350, 330. If we come down hard, I'll be looking to shop for some premium on Tesla stock down there in a level that I prefer a lot more. So Tesla, not looking the worst right now. The bulls have a chance to save and, just use this area and just create a new area of consolidation in this area right there. I'm not saying they have to flush, right? We can just create a new area of consolidation. And I think that would be a good thing as Tesla kind of moves into its new valuation at these higher levels. I'm still playing Tesla with a little bit of caution. Now moving into Palantir. Palantir down about 2.4% today. Now Palantir as well, right? Big sell-offs in the last few days of trading, but have we lost any major levels? No, still a very clear daily uptrend, looking for a daily higher low. Anything above 70.36, looking for the daily higher low for possible further trend continuation, but they got to get their act together now. Previous resistance is now current support, the 12 EMA acting as support. You can see the bulls, they have lost the 12 EMA intraday sometimes, but they have not lost it for more than one day. If Palantir closes a red day tomorrow and loses this, that'll be the first significant loss of the 12 EMA since the earnings on November the 5th. So keep that in mind, guys. That will be something notable to us, right? If we lose more ground here, the bears have a chance to fully engulf, and then you open up the door for what? Lower high into possibly lower low, which opens the door as well for further weekly consolidation. Weekly consolidation, in my opinion, could bring us down. First stop, 72 down to 68, and second stop, probably the 12 EMA around 66. I'm waiting for this. I've been waiting for this for a while, guys. We've always been looking for a weekly higher low for possible further trend continuation. The weekly time frames have been severely overbought, and now you can tell, right? Now you can tell what's about to happen if the markets fall off in January, right? Palantir, look at these monthly candles. Very extended from the 12. This can only last for so long, guys, before eventually you do have to set the monthly higher lows for if you want the further trend continuation. Palantir does it all the time. Rally, monthly consolidation, rally, monthly consolidation, rally, monthly consolidation, rally. Where's the monthly consolidation? Is it coming sooner than later? They have all the chances to do this in January, guys. So can we see a January, February down and then the rest of the year further upside? Yes, but keep that in mind. I will be patiently waiting. If they drop Palantir as well and people start panicking and they say it's over, I'll be waiting down here, guys. Sell me your shares in the possible mid to low 60s, and I will gladly pick them up for a little bit of a swing trade. So that being said, that's it for Palantir, but still right now, the bulls are looking good. I'm just giving the expectation, right? Hope for the best, expect the worst in the month of January. That is my slogan moving forward. And lastly, SOFI. Yes, SOFI, a new entrant to our list. A lot of people have asked this. I've been contemplating it for a few months. It was either going to be SOFI, TSM, or Visa. TSM, we already have two semiconductor names here in AMD and NVIDIA, and we don't have any financial names here. Right? So I figured that I should put, it was either going to be Visa or MasterCard, but those are kind of boring, right? Whenever I take some trade opportunities on them, I usually always give them to you guys. I want volatile names that have a lot of attention on this list right now. I mean, big tech is obviously there for a reason, but SOFI, right? We'll put SOFI. We'll do this one every day moving forward. SOFI down about 2.19. What are the bulls trying to do? We are trying desperately to defend this location. We moved up into this area. Now we're trying to use the bottom end of this zone as a last area of defense. That is 14 down to about 1450-ish, right? This whole bottom end of the range, that is what the bulls are looking to use as support. That being said, beautiful weekly uptrend by the bulls right now. This makes the most sense on the weekly, guys, right? It's just been a weekly area of consolidation, and I do think that it may continue. Look, consolidation sideways is not a bad thing. We've cooled off the weekly timeframes a lot, but on the monthly, same thing as Palantir, right? Eventually, you do need to set up for some monthly higher lows for further trend continuation. Can the month of January and early February be that perfect catalyst, perfect storm for further downside consolidation? Yes, but I will be a buyer down here. If we come down here 14, 13, even 12, I'll be looking to load up in SOFI in this entire range, and I'm using short puts to do so. Writing puts under the market. If I get a sign, perfect. I'll DCA and DCA and DCA all the way down to 12 because I'm looking to build a position through these monthly higher lows and go for that monthly trend appreciation of SOFI and the expansion of the business, the expansion of the fintech landscape as a whole, as these fintech brands start picking away at legacy banks' market share, right? This pullback is what I'm trying to do, but it's very tough to time the absolute bottom and go in with full size, right? I would rather progressively buy the dip, accumulate some positions, and then we're ready to rally. I have a ton of shares, and we're looking for the upside continuation on the monthly. But as of right now, The SOFI bulls have not lost anything. They haven't really lost daily higher lows, no daily downtrend yet. We haven't lost the weekly lows just yet. Still playing some pretty good defense, all things considered. But be careful on this one as well, because you've seen the amount of uncertainty that's been brought forth into the markets over the last 2-3 weeks. So please keep all of that in mind, guys. So that is pretty much everything for your broad market analysis. Now, this is the last one of its kind, guys. Moving forward, all these videos will be a lot shorter because I'm going to save, I'll still give you guys the context and everything like that, but I'll be a little bit more shallow in my explanations. I'll keep that because I do so much in the Discord, guys. Every morning, I do like 2 to 3 hour live streams sometimes explaining these concepts in detail. For the YouTube videos, I'll do longer recaps on the Friday session. They'll be over an hour with the portfolio recap, full sector rundown, and a lot more context. But for Monday to Friday, to be favorable to the algorithm, and because I know your guys' time is precious, a lot of people are working, maybe you don't have time to watch an hour video every single night, and I understand that. So moving forward, these videos will be approximately 30-40 minutes. I can do it. We've done it many times in the past. It's just I have to go through the analysis a little bit quicker. The context will be a little bit shorter as well. So if you're following the videos on a day-to-day basis, you'll be able to follow along, right? But the reason I gave a lot more context now is because some people are new to the channel, so I like to give context in the event you haven't seen my prior videos. Anyways, suffice to say, at the end of this year, today and tomorrow, it's the end of the very long videos. I'll be keeping them to 30-40 minutes. We're going to optimize for the YouTube algorithm a little bit more, optimize for the channel growth. And obviously, if you guys want a lot more detailed explanation or talk with me directly, then of course, we have the Discord service for that. So hopefully you guys understand. I kind of made these videos longer and longer as the year went on to just, be able to provide more explanation and more in-depth concepts and context. Hopefully you guys have learned a lot. Now, let's look into a few trades that I made over the course of the day, shall we? Okay, so for the portfolio recap, and before we do that, as a matter of fact, this portfolio I will now be showing publicly moving into the new year. I will net it out to a value. I'm still undecided whether I net it out to $45,000 or $50,000. As of right now, guys, we're always trading about $100,000 of exposure, and that will not change. But I want to make the journey of this YouTube portfolio, right, a lot more accessible to people. And I think the perfect middle ground for that is having an account about $45,000-$50,000. Now that opens up the door for some bigger strategies sometimes using a little bit of margin, but it also favors a lot of smaller account strategies as well. So to keep a perfect mix right now, I've withdrawn a lot of the cash out of this account. I still will be running 80, 100K exposure, but some of that will be on margin as well. So I'll be revealing the account values and everything like that moving into the new year. I'm still undecided whether I put it at 50,000 or 45,000. It's like a psychological thing, right? When people see 50,000, they think, oh, it's a bit too much. It's like when you go to Walmart, you see something for $10 flat, you're like, oh, it's $10. But when you see it for like $9.50, you're like, oh, it's only $9, right? So I think I might net it down to like 45K just to make it more accessible. And then we'll grow this account together, revealing the full account balances and everything, right? But I feel it's sometimes a little bit out of place when you show like a 6-figure account because not everybody has a 6-figure account. And anyways, that's why I've been kind of just focusing on the trades themselves. I always show my wins, always show my losses, but I found that showing the balance sometimes is a little bit intimidating for some people. I know a lot of people like that. They like to be motivated by this stuff and whatnot, but for every person like you that gets motivated, keep in mind, maybe 2-3 people out of 10 get motivated from seeing high balances. Other people just kind of get a little bit discouraged and they say, well, this guy might be a little bit out of touch. I have a very small account type of thing. So to play a perfect middle ground, I will net the account down to 45, 50,000. I'll show the rolling balance moving forward into the new year, and we can just continue on with this YouTube trading account. As you guys all know so far, I have 2 accounts. This is the trading account for YouTube that I built early 2023, where I show you guys all the trades and whatnot, but I have a much larger account as well, in which I do very passive strategies employing, I'm writing short puts on stocks like Microsoft, on the SPY and stuff like that. And those are like $50,000, $60,000 trades each, right? So it doesn't serve me much purpose showing that because not a lot of people have access to it. I'd rather show you guys a tons of different strategies like call debit spreads, share swing trades, smaller leap call contracts, the wheel strategy with smaller trades and optimizing for premium, swapping them out midway through the week. So a lot of if I had a small port, this is my attempt at showing you guys, if I were to have 40, 50K again, how would I be trading it, right? So that's kind of the experiment that we've been doing on the YouTube channel publicly. So hopefully you guys have appreciated the last 2 years, and it's been very fruitful so far. I mean, this year I think we're up like over 50% so far in the markets. We've pulled back a lot since Jerome Powell. We were up like 65, 70%. Now we're up like, I don't know, like 50 something percent overall year to date. Last year we were up like 77%. So we're crushing the SPY and everything like that, but we have pulled back a little bit, but it's been very successful so far. Hopefully you guys have learned a lot, and it's been a very pleasurable year for me. So hopefully you guys have enjoyed the process too. In terms of the new trades today, well, I did a full portfolio recap on Friday. If you haven't seen it, it's at the end of the Friday recap video where I go through every single one of these positions. For now, I'll just be reviewing very quickly some of the new positions for today. So not much has changed. One of the few things that's changed though is we replaced the Amazon covered calls. So I'll show you what it means in the Discord. Right, I'll show you, I'll show you what it means in the Discord. Let me just go in here. Where are we? So we're in the weekly recap section. So in terms of the Discord, guys, in terms of this one, we reallocated the Amazons. You might remember I had the January 10 covered calls, which we got for $4.75. I closed them today at $1.15, $1.20-ish. That is roughly 75% profit on the first batch of covered calls, which were expiring next Friday, January the 10th. We then replaced them with new covered calls for $5 to $5.10. It's a range, right? I give a little range when it was launched. You can see the net credit was about $3.85. Where does that leave us right now, guys? Well, these Amazon covered calls, I'll remind you, are against our leap call contracts that we have. These 185 long leaps, which are currently still up about $1,100 on them roughly, right? So now what we've done is we've already pocketed a decent amount of premium. We've pocketed $355 in our pocket. Now we have added another $385 to our pocket in premium as well. Total premium collected, $740. That helps protect our leap a lot. And it also gives us a very high break even. Amazon can rally up to $237.40 because these are 230 covered calls. They can run up all the way to $237.40 before we lose any money on the covered call strategy. And it stands to argue if Amazon does rally up to there, our long side of the leaps will be up a tremendous amount. We'll be able to close the short calls at break even and close the long calls at a very nice profit. But if Amazon comes down through the month of January, as is my baseline scenario for the whole market, if it comes down, we put $750 total in our pocket, and then we can ride this leap into next year because the expiry is for January 16, and I'm pretty sure that Amazon will have a pretty good year. So we're just looking to farm some premium with some covered calls against the leap. So hopefully that strategy makes sense. Other than that, we still have a lot of ongoing leap plays, as you can see. The average price here, we still have a lot of wheel trades for the week, guys. None of that has changed. AMDs, the 120 puts for next Friday, we're still in those. The other ones too, we're still in the BITX 45 puts. Bitcoin had a bit of a drop today. We're still in this one. We got almost 60 cents. They're down to 40. So we're up on the trade, but this trade remains live until Friday. We still have the Ethereum trade for January 17th. We got in for 35 cents. They're at 25 cents. We're up on that trade as well. The Googles, this leap call is still covered. I have not touched that portion of the covered calls. These are for January. We've got $8, guys. Going to be a very good experiment in bringing down our cost basis and adding to the premium tally. Now, NVIDIA, I did the exact same thing. I also rolled the covered calls forward after a big rally on NVIDIA today. Look at this trade on NVIDIA. We had already the 137 calls for $1.50 in credit for this Friday. What did I do? I rolled them for another Friday forward. So one more week, rolling the January, right, close the January 3rds for this week, open the January 10th at the same strike, the assignment strike 137, and we got $1.80 in net credit. That brings our assignment tally, or our average cost after being assigned at 137, after all of these premiums, right, from the covered calls, an average cost is now down to $129.69. So we have now effectively brought down our average cost by almost $8. $800 of covered call premium has been farmed on 100 shares of NVIDIA stock. It's been a very profitable endeavor so far. So we will see this one. Very simple, guys. I'm just looking to pocket some premium. If NVIDIA comes down, we'll pocket more and more premium, lower our average cost basis, and then we can take the trade from there. So that is what we did today. And then, of course, our other wheels are still live. SMCI 27.5 puts, those are still live. We added some SOFI, one contract. As I said, I'm looking to buy the dip on SOFI. 15, 14, 13. Build a position slowly because I acknowledge that there could be more volatility on the horizon. 15 puts, we got 20 cents for them. The contracts are doing well today. We're already almost 50% profitable on these. right? So we are making a decent amount of money. I would not be surprised if SOFI has a big, if the markets continue selling off, we could get assigned on these. But as of right now, I'm happy. Over 1% in premium, a little bit aggressive on these. 15 short puts for Friday. We still have the SOXL contracts as well. 24 puts for the Friday session as well. We still have the Square 83 short puts for the Friday session. We got them for 44 cents. They're down to 30. So we're up on those as well. And that's pretty much it, guys, right? We still have the TSLL, which is the 2 times leveraged Tesla, which we got for 17 cents last Friday. And even though it came down today, we are still up on this trade because we have such a wide margin of safety, guys. Look how far we are down on TSLL. We are all the way down another 21%. Tesla would need to drop 11% by Friday for us to get assigned on these. And if they do, no problem at all. I will take assignment of my small 100 shares and write some juicy covered calls. So that is what I'm doing with the portfolio. As you can see, as I said last Friday, most of all my leaps right now are covered. I have covered calls against all of them. As a matter of fact, I even extended a few of them today, such as Amazon and the assigned shares NVIDIA. I am also playing a heavy amount of defense. And when I am going for bullish trades, like these short put trades, you can see how far I am going under the market. I'm going so far under the market, still getting 0.5% though. I'm going so far under the market that even when we have more red days like today, I am still up from where I wrote them on Friday because the time decay, the theta decay is outpacing the declines in the market. That is what I'll be doing the entire month of January, waiting for red days and then writing so low while still getting 0.5%, writing so low that it takes a truly outsized move down to actually assign me. And if I do get assigned, I'm at very low and attractive levels. So that is how I'm playing the account moving forward. No more call options for right now. Not many more call debit spreads either. Now we start to play a little bit of defense. So my leaps are all covered up right now as a whole. And the wheel strategy, I am playing it a little bit more conservative rather than aggressive. We are now on the playing defense. I'm still cautiously optimistic. I think January down, early February down, and then March, April, May, probably a decent segment in the market. But that is why I'm playing defense, looking for the best possible prices through January declines, loading up the bag, and then we will make a decent amount of profits, February, March, April, May, and onwards after that, right? So that is kind of how I'm viewing the next kind of 30, 45 days in the market, and that is how I'm positioning accordingly as well. So hopefully all of that together helps you improve your positioning and your analysis of the markets. As I said, guys, nobody has a crystal ball. The best we can do is use all the data available to us and make the best educated decision we can in terms of risk management. Never forget, guys, risk management is number one, front and center. The business of finance is not the business of profit maximization. It is risk management first. And only if you have very good risk management, you will find that you will be maximizing the profits in the long term. But it all starts with managing the expectations for the risk and moving into a volatile market where it has all the context it needs, all the possible justifications. The media can run with anything it wants at this point. The narrative to the downside can be inflation, it can be interest rates, it can be Trump. They can use anything they want, guys, and nobody would be surprised because of the doubt that Jerome Powell put into the markets just a few short weeks ago. So keep that in mind. That's the narrative that we have at hand right now. We have to deal with it moving forward. So I would rather be a little bit more cautious while still being a bull, while still being optimistic about 2025. We can be a little bit cautious leading into our January positioning because we know they have all the excuses in the world, all the catalysts in the next 3 weeks to play off of these and insert the bear narrative if they want to. So keep that in mind, guys. If you enjoyed today's video, consider dropping a like. Would really appreciate it for the growth of the channel. Also, consider subscribing to the channel if you're new. We do these every Monday to Friday after the close. And lastly, if you have any questions, of course, please feel free to leave them down below in the comments section. I always answer your questions every 24 hours, guys. Whatever you want. If you want my opinion on a stock without it being financial advice, I'll help you out there. Whatever you want, guys. It's always fair game. You guys know me. I answer pretty much every single question that I get asked. So feel free. In the event you guys want access to the private Discord, the link to the Discord is down below in the description. You can have access to all of these trades. Here are the weekly trade recaps. All of the trades since the inception of the Discord. I always show them the wins and the losses. You guys know me. I'm very transparent with that. So if you want access to all of the real-time trades, the wheel trades, right? The credit trades, whether they're put credit spreads, short puts, anything like that, or the called option trades, right? The call debit spread trades, the swing share trades, the long-term portfolio trades. All the access to the trade alerts is in the private Discord. The link is down below in the description. We also do private morning live streams every Monday to Friday for about an hour or two, sometimes even more, where I do trade live and answer all your questions in real time. Private videos on more strategies, psychology of the market as well, and many different things that I do not post on the regular YouTube channel too. And you can obviously chat with me all throughout the day if you have any questions on your stocks, your options, and want my opinion, and I can respond there very, very quickly and support the analysis with charts, screenshots, and all things like that. So if it's something that interests you, no pressure at all, but the link is down below in the description. So hopefully to see you in there soon. And if I don't, well, I guess I'll see you back on the channel, guys. That's it for me. Take care. One of the last videos of its kind, guys. I know some of you like these long format videos, but a lot of people don't, or they don't click on the videos. So to kind of grow the channel and help myself out the most I can, trying to grow the brand and whatnot, help even more people, I'll be keeping it shorter now moving forward, 30 to 45 minutes, but I promise you, I will do my best to not lose any value, any context whatsoever. It's just that it'll become something that you kind of have to follow on a daily basis rather than me explaining everything fresh as if you're new to the channel in every single video. That's what makes them a little bit longer nowadays. I take in consideration that everybody is new to the channel, and I try to explain the context of the past few weeks as a whole. Now, I'll only give the context of where we currently are in the last few days, but not much more than that, and we'll follow it up on the weekly basis. And the Friday video is where I'll go more long, like an hour plus, and I'll do a full recap, full context, and explain everything a lot more in depth. But the weekly videos, Monday through Thursday, because I know you guys are working, you have a lot of things to do, of course. Well, I'll keep them shorter to respect your time and to manage the videos more efficiently. So take care, guys. That's it for me. Love you guys as always. Take care. I'll see you tomorrow after the close. Have a good session and peace.